Well, welcome to the monthly economic update for the month of September. I'm John Cleaver, partner and senior financial advisor.
And I'm Dennis Bacon, the Chief Investment Officer at Beyond Wealth Advisors.
All right, well, we're going to get right to it. I know the last couple months have gone a little bit longer. Try to shorten it up a little bit. So, what's going on with this unprecedented market slash economy that we're in right now?
Well, what's going on right now is for the first time in several months, the consumer confidence is up. This kind of seems unusual. The also core retail sales are continuing to increase for the 7th month in a row, and the job market remains strong. We've actually had 4 months of declining jobless claims. So less and less people are looking for jobs.
Okay.
Which more and more people are needing employees. But so it was pretty strong economy. On the kind of a neutral side, inflation is still at a high level. We're 8.5% was what we were at last month, and that actually is a slight decrease from prior. I don't put a lot of credibility on that because most of that is because of the drop in gas prices.
Right.
Everything else is still as inflationary as it was. And we're still seeing, anecdotally, I paid the lowest price for gas I paid in quite some time over the weekend, under $3 a gallon.
Yeah.
So, so we're seeing that kind of drop. On the other side of it, the more negative side, is housing prices, or housing sales rather. Every aspect of housing is down, and the prices are up over 18.5% over the course of the past year. So what's going on? We're still having some strength, and we have some mourning areas.
Right.
Is kind of what we're seeing right now.
So you touched on an area that a lot of people are hearing a lot about in the news right now. That's inflation, and so kind of what's going on currently. So when you think about the near term, right? So we know long term the goal is to get inflation down, and the Fed has a target for that. But what happens in the short term?
Well, a couple of things. First off, the target, the Fed does have a major target for it. And I think a year from now, we're not going to see inflation nearly where it is now.
Right.
Maybe it may still be over 3%, but we're certainly not going to be in the 7, 8, 9, 10% range that we're kind of looking at right now, depending on where you're at. But right now, also the things that's really happening is the retail inventories are way up, which means the supply chains are getting much better. Transportation prices are falling, thus the gas prices. So transportation prices are falling. And for the first time in many, many months, we're actually seeing retailers discounting the price of their goods. More sales are happening that are significant. And so I think those are some things that would imply that maybe the robust economy is lagging, and ultimately that will mean inflation comes down. Not yet, but it will be coming down.
Starting to roll over a little bit.
Yeah.
All right. So transitioning then, let's talk about in view of the market itself.
Okay.
What does this really mean?
Okay. Well, it's kind of an interesting thing. I'm going to kind of give a little market history here. Since 1950, we have never had a market that dropped by 20% or more and then retrenched back up towards its high, dropped below that prior low. So, and what we have seen this year is we had a high in mid-January for the market, almost 4,800 on the S&P. We dropped almost 23%, a little over 23% by mid-June of this year. We then rose about till early August, went up over 50%, gained 50% of it back. Now we're down a little bit more. We're actually down 18% right now, is where we were as of this morning. Like I said, going back to 1950, we've never seen us break through those lows, which in this case would be the lows in June. Doesn't mean we won't, but all the indicators are that we really shouldn't. So in general, I think that over the course of the next year or next 6 months or so, we're going to see kind of a sanguine market. It's going to be volatile, but it's not going to go anywhere. It's going to be range bound. Probably by the end of the year, we should see a little trending up from where we are currently now.
All right. Well, the other thing we've been hearing a lot about in the news, if you pay attention, is this word recession. And when are we going to be in a recession? Are we in a recession now? Is the recession going to be in 2023? So what you say, Mr. Dennis?
Well, I don't think we're in a recession now. There's just too many indicators that are still so positive that typically you don't have during a recessionary time. I do feel very strongly that we will have a recession in 2023. Now, this is probably the most telegraphed recession in history. So what that means is that we all see it coming. We see the freight train coming through the tunnel. We know what's going to happen. But because of that, the markets will prepare for it.
Right.
And it's already being built into the markets. That's why we're seeing the volatility we're seeing now. That's why we'll see a little bit of recovery after the elections, not as relative to what the election results are, but it'll take that uncertainty off the market. So I think that's what we're going to see over the course of the next year. And it's mainly because everything is just so built in that once we have a recession, we're actually going to see a recovery on the market side, which often happens. Once we know we're in a recession, the market's going up. So,
well, and you talk about this often, the difference between talking about the market and the economy. So when we hear the word recession, we think, oh, that's bad. That must mean the market's going to be bad.
Right.
The reality is the recession impacts the economy. The market itself may react and or build into itself.
Correct. It's going to come out differently. And in this case, it's going to be way ahead of the market. It's going to be way ahead of the economy.
So with that in mind, what should investors be thinking about or be doing today?
Well, first off, I don't think it's an abnormal situation for the most part.
Yeah.
I do believe that it's important for investors to have a little bit of dry powder or cash, not extreme amounts of it, but a little bit of it available. A, in case things get a little worse and they need cash. B, so you can take advantage of some opportunities that may arise over the course of the next, 2, 3, 6, 12 months.
Right.
So having a little bit of cash, I think, is not a bad idea, having the sideline. Still staying within the range of what you have defined as what your risk level is.
Right.
How much risk do you want to take? How much volatility can you take? You should never be in a situation where you're going to put yourself in a situation where you're losing a lot more money than you can afford to. It's important to work with your advisors that you're working with and take a really good look at that, so make sure that you are in the right position from a risk level.
Well, you're exactly right. And with that, we do want to just encourage you to talk with your advisor. In these times when the market tends to be more volatile, it's a great opportunity to revisit your financial plan. Don't necessarily make those knee-jerk reactions just because things are a little bumpy. It is potentially an opportunity for you to take advantage of what's going on as well. So with that, we'll wrap up September's monthly economic update, and we look forward to seeing you next month.
Right. Enjoy football this year.